Over the weekend, we saw the Chinese repo rates spike up. And we saw this initially in the summer, and we could just take a look at this article in the Wall Street Journal. China credit squeeze eases as central bank resumes regular cash injection. So we have here, number one, article by Shen Hong. The stress in China's financial system appeared to be easing early Tuesday, as short-term borrowing costs fell following the central bank's decision to resume using its most popular tool to inject cash into the money market. Okay, let's go down, and we could look at this graph over here. And we could see a spike here in June. The repo rate reached 11%. And then over here, on Monday, it reached 8.94%. And then let's take a look further into this article. The weighted average of the 7-day repurchase agreement rate, a benchmark cost of loans between banks, opened trading at 5.5%, down from the 8.94% Monday, which marked a fresh high since China suffered an unprecedented cash crunch in June. So, when I initially saw interest rates spike in China, the first thing in my mind was, hey, this thing is Lehman. This is what my thought process told me in June. And I'll show you why I thought this was automatically Lehman. I did an interview on this, and some people thought that I was insane for saying this. But I'll show you why, or what made me say this, so some of you guys can understand where I'm coming from. Okay, this is a graph from John Taylor's website. He's a professor at Stanford University. And what I noticed were similar moves, or you could see not similar patterns, but it just reminded me of what's going on in China right now to a certain extent. So this was in August when subprime was starting to blow up. This is August 2007. You see the LIBOR OIS spreads here, right? It should usually be 10 basis points. And this is just a measure of credit strength or credit weakness. And if you look at it, see this, it's like around 10 basis points. And it spiked up to like 90 basis points, 100 basis points. That was a red flag. That was actually a black swan, which nobody actually talked about. You talk about black swans and Nasib Talib, right? This was definitely a black swan, according to John Taylor. He figured that out. And then let's look at December, right? It spiked up here. And then you have to realize that there were two double tops here. But then you had central bank intervention to decrease the spreads over here. And then you had the term auction facility program, which alleviated the stress in the credit markets here. And you could see that these rates went back down. But you have to remember this. If you are dealing with credit spreads and you're seeing all this weakness, if you just pour money into the system, that's only going to temporarily help the system out. You cannot simply pour all this helicopter money into the system to relieve a credit crisis. This is a solvency problem. You need to liquidate the malinvestment, as the Austrian school says. And we're not doing that. China's not doing that. So right over here, this is definitely a red flag. I mean, this is not China, but this would have been a red flag for the central bankers. So let's look at this. Once again, you're going to see two tops here in the repo rates. This is the Chinese market, similar to what happened in the United States in 2007. And the difference is this time you see the repo rates going to like 8.9%. This was higher. The two repo rates for the American market, or what happened in the LIBOR OIS spreads, they were actually even. They were close to 100 basis points, the LIBOR OIS spread. So if you want to look at this though, why did I think this is Lehman? Because the credit markets forecasted problems that later would ensue in 2008. Are we going to have a repeat of Lehman? Well, I initially thought this, but then I've been thinking about this over the past few days. And this is just a sports analogy. Suppose you see this one player and you get burned constantly, and the team constantly gets burned. eventually they develop scouting reports to try to figure this guy out. Sometimes they're going to completely figure this guy out, and at other times they're going to only figure him out because he's so damn good. You cannot stop this guy from going past the defense if it's football, or if it's baseball, he continues to hit it in spots that you wouldn't imagine. But for the most part, teams get smarter. They figure out a scouting report, and I've played sports. You figure out people that you play with, you understand their weaknesses and strengths, and then you try to capitalize on it. And central bankers, in my opinion, after thinking about this, are probably going to do the same thing, especially with China, especially with what happened with Lehman. So my two scenarios are, okay, this could be a repeat of Lehman in China, or B, the defense is going to adjust, or the central bankers are going to adjust based on what they've seen in the past. And how I think they're going to adjust is, now they've come up with a different game plan. They've come up with the bail-ins, right? Remember the bail-ins in Cyprus, where many of the depositors got screwed over, especially the rich? That's what I think is going to end up happening. Or three, what they're going to do is they're going to have more central bank liquidity going into the system. And initially, this is going to alleviate the credit spreads. But eventually, it's going to hurt margins, hurt earnings, and B, it could create a stock market that will go down. And initially, you could see this liquidity. It could make the stock market go higher. It could make oil and commodities go higher. But eventually, I think it's going to hit them in the you-know-what, and I'll show you why. Okay, this is a graph of oil versus the Fed funds rate in 2007, 2008, so I could show you. And this is it's actually 2006 to 2008, and this is from John Taylor's book, Getting Off Track. And the first graph that you saw regarding the LIBOR-OIS spreads, that was initially in this book as well, but I got it off his blog, John Taylor's blog. Let's look at this, okay? So I showed you that in 2007, around this time, where you saw the LIBOR-OIS spread starting to spike up. This is like August-ish, right? And you could see the Fed funds was 5.25 here. And oil prices, if you look at it, were in the $70 threshold, somewhere around there. So oil prices were somewhat stable at that time, even though it was much higher than the Clinton administration. So what did the central bankers do? Like I said, they started to cut the Fed's funds rate, especially in the United States, to try to relieve the credit system, right? Because this actually freaked out Bernanke. This was why he cut rates. And as he cut rates, oil prices went up. Remember, inflation is always a monetary phenomenon. And this is what happened. You have to remember, the economy was more dynamic. So when they cut Fed funds rate at that time, it just was a disaster waiting to happen. That's why you saw all this inflation spike up. And the only reason why we don't have the nasty inflation right now is because A, they're misrepresenting the inflation, and B, you have anti-business individuals in Congress and the president who are not allowing the free market to grow the way that it should be. So you have all this cash on the sidelines. And once that cash comes out, this is going to be much worse than 2007, 2008, in my opinion. And if you look at this, though, what are the Chinese going to do? What are other central banks going to do? They're going to cut the Fed funds rate. The only thing going in the favor of these central bankers right now is that there are a lot of unemployed people. Two, you have to look at the fact that businesses aren't expanding to the extent that they are. But you have to remember, if you start to see these dollar pegs broken off, then the races are off for inflation. I mean, we could see $120, $130 oil, as crazy as that sounds. I think it's in a trading range as of right now. But because of the petrodollar system and because of how the Arabs may protest higher oil prices, this could be troublesome in the years to come, in the next few years. And that's why you may see some individuals, like I said, like Mike Status, he's getting out of the stock market. I'm thinking to myself, this is a red flag. Why would Status get out? And two, because his track record, if you look at it, it's fantastic, regardless of whether you agree with his other views or not. I'm not going to get into that. But two, you want to look at another red flag, credit markets. 3, you see Wall Street getting all giddy and exciting. You see all these people saying, you better get into stocks, this and that. And I've noticed some cockiness going on. And I always view cockiness all across the spectrum as a red flag. So these are my thoughts. And another thing to note is I've talked to sophisticated traders. Some of them have come on my show. And what they said a few months ago, or maybe a little before that, is that it looks like the stock market's going to peak this year. Gold and silver most likely going to start to rally soon, probably in the fall time, early next year. And 3, there's probably going to be a slow but gradual decrease in the stock market of 20-30%. So there are many scenarios going on in my mind. One part is saying, hey, this is a repeat of Lehman, but then the other part of me is saying that, hey, you know what? Central bankers have seen this before, just like sports players have seen the players and they understand the scouting report much better. Central bankers have a better scouting report, so they're going to probably react differently than they did in 2007, 2008. And then scenario B, adding on to it, is you could probably see a 20-30% decrease in the stock market over the next few years. There's some other indicators that I've been seeing, but this is just what's going on in my mind. I have no guarantees, so don't invest based on what I'm saying. This is just my own thought process, guys. And anyways, thanks for listening. Hope you have a nice holiday season, and I'll talk to you later, guys. Thanks.